Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, �ル𝙊𝙇𝘍. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everyone, this is 𝙂𝙁𝙁𝘾 with Liberty in Finance. And back with us today is our good friend Robert Kientz from Gold Silver Pros. Robert, thank you so much for joining us today.
Thanks for having me on, Elijah.
It's great to have you, and we are live here on the 15th of June. This is right following the Fed meeting, the much anticipated Fed meeting, as we're seeing a lot of chaos in the markets. The Dow was down significantly this week and has been down this year quite a bit. The S&P, I believe, is currently officially in a bear market, down more than 20% for the year. And it seems like the markets were saying the Fed has to do something. And what they did was they ended up raising rates more than they had talked about initially. So it was planned to be a 50-point rate hike, and now it's 0.75 point. That was just initially officially announced. There, your take on how the markets have been reacting to this announcement?
So far, it seems like the markets are fairly calm. Gold and silver are up just a tad. The rest of the markets seem to be doing okay. I think the buzz about a 75 basis point rate hike started a week or so ago, and I think the market was, at least in the short term, pricing it in. I still think it's going to have a longer term effect in terms of the cost of capital, which is undoubtedly going to affect Wall Street and therefore the balance sheets and earnings. So I think we'll have to see a quarter from now, what the Fed decisions, what kind of effect that they're having when earnings come out. I do notice that now they have moved up their target rate for the end of the year to 3.4%. I think late last year, we were expecting about 1.8% because they were talking about 25 basis point hikes. Now they've gotten 2 to 3 times more aggressive. So we're going to have substantially higher federal funds rate at the end of the year. I've seen a lot of articles that claim it anywhere 2.5% to 3.5%. It causes severe distress among the market. I do know that about every 50 basis point hike that they make causes the government to have to spend almost $1 trillion more in servicing debt over the long term. So this definitely, even though it looks as though the markets are acting okay right now and they're not in chaos about the announcement, I do think longer term that there are going to be quite a few effects, and we're just going to have to watch and see what those are.
You mentioned, how markets are pretty stable right now, it seems like, at least for today, immediately following the announcement. But we did see quite a bit of selling pressure earlier this week and on Friday as well. I mean, we got the inflation number that was higher than expected at 8.6%, the official inflation rate. So your perspective on this and how that changed market dynamics?
Yeah, I think people realize inflation is not transitory at this point, and it's pretty obvious. Hedge funds, there's an article here in Zero Hedge, hedge funds have sold stocks at the fastest pace on record, even surpassing 2008, 2009 with the Lehman issue. So there is a ton of selling going on in the market, along with the fact that we have lowering money supply. The M2, or if you're an Austrian economist and you follow true money supply, TMS, have both fallen off a cliff since about mid last year. So there's less money slashing around in the market to bid up stocks at the same time that the hedge funds are basically selling them, and that's where you're getting the tremendous downside. Now, as to where this stops, I'm not really sure, because the Fed's going to continue to hike throughout the year. So I don't know that we're ending the sell-off just yet until the Fed decides, hey, we're going to keep interest rates even. And then I think we'll have probably a little bit of a dead cat bounce at that point.
Now, it seems like we've seen this selling just in the last week or so, kind of because of the shock of the high inflation number, and now kind of the anticipation that the Fed was going to raise rates even more. So do you think there's going to be any further shocks going into the end of the year that the market is not already pricing in?
Oh, yeah, I definitely think so. If you look at bonds right now, they're rising really fast. We had a very momentary yield curve inversion a day and a half ago. I put this on Twitter, where the 2-year U.S. Treasury was trading at a higher interest rate than the 10-year. Those two benchmark rates, when they invert, meaning higher rates in the short term indicating more risk, tend to point to an oncoming recession. If you add that in with the fact that OPEC spare capacity is crashed, and every single time that that has happened in terms of the available oil spare capacity has crashed, that's also pointed towards an oncoming recession. And then if you look at the amount of money slowing down, the M2 and the TMS, the amount of money available for credit and finance, that also points to an oncoming recession. So all of those are indicators saying we're having a recession. I believe the bondholders, probably more than anything, they're some of the smartest traders out there. They price everything and they look at everything when they make their bets on bonds because it's a long term. I don't think stock holders do that as well. So bonds usually tell the story before stocks, and the rates were rising before the stock market started to crash. And I think the rest of these indicators are telling us that we're going to continue to have a recession throughout the end of the year, or at least until the Fed stops hiking rates. Now, if you remember what Powell said at the beginning of the year, they were going to raise rates, but if they saw the economy contracting too much, they, kept the option of basically reversing course or at least holding steady. They show no signs of doing that now, obviously, today. So I think they're really looking at unemployment, and they're looking at very high interest rates, or I'm sorry, inflation rates. And they know that really the only way to slow this down is to get interest rates above inflation rates. That's historically what's done it. So I think they're going to continue to do it, even though the market is a mess right now. We'll just have to see where we stand by the end of the year. But I don't expect, unless the Fed reverses course, I don't expect to see any sort of recovery this year.
So we're looking for a recession coming. Now, correct me if I'm wrong, but technically a recession is when you have 2 quarters of decreasing growth. So we're going to be seeing whether we're in a recession right now or not pretty soon.
Yeah.
And can you share with the viewers a couple more reasons why you think that a recession is ahead? Because I mean, we're even hearing that on the mainstream now, a lot of people saying that.
Yeah, earnings reports are down is another indicator. When companies aren't making as much money, it's a sign that you may be heading into recession, especially with all the excess money that was sitting out there and all the debt that companies could have taken on. You would have expected that all of that investment in R&D and things would have led to continued rising GDP, even in the face of rising inflation. The problem is a lot of that's misallocated capital. If you follow Austrian economics, when money is easy to get, it gets spent on all sorts of things that aren't productive. It has, however, raised raw materials prices, commodities prices. I'm looking at a graph from Statista, which shows that year to date, since January, coal is up almost 70%, wheat is up 60%, natural gas is up 54.5%, nickel's up 46%, oil is up almost 30%, European natural gas is up 26%, corn 23%, platinum 21%, palladium 14%, zinc 11%. All of these materials are needed in the economy. And the wholesale print earlier this week, or the PPI, showing what the producers buy their wholesale goods for, was up into double digits as well. I believe that was like a 10.8% print. So we continue to have high prices in the economy, and where wages aren't rising as fast, which they're not, consumers can't buy as much, and consumer spending is down for the first time this year as well. So with consumer spending down at 72% of the economy, and with inflation raging, and with wages not keeping up, and with the labor force participation rate still hovering around 62%, unless the government continues to spend a lot of money, I don't see how you can have expansion. So yes, I do think that we'll officially get the inflation call this year, because I think this quarter we will be probably negative GDP. Already CEOs and other business leaders are saying for sure that we should have negative 1.7% growth going forward. So I think everybody's basically priced in the recession. The question is, how bad is it going to be? And a lot of that, of course, has to do with the Fed.
Definitely. And for our viewers just joining right now, the Fed has raised rates 0.75%, so 75 basis points. And it seems like markets have already priced this in. This was what was expected from the top analysts. So it seems like we're not seeing too much movement right now in the markets. But Robert, I know that you have been talking about for a while that you do anticipate eventually the Fed reversing course.
Mm-hmm.
And kind of, you mentioned recently on your channel, your YouTube channel at Gold Silver Pros, that what the Fed is doing right now is kind of giving themselves room to finally reverse course and bring rates lower.
Yeah, I think the Fed in many ways knows that the economy is overheated and there's a risk of eventually a hyperinflationary type of issue. And I think that they also know that they've got to curb the amount of money that they print and the amount of debt that's allowed, because you have all this money flowing in from Eurodollar accounts. And a Eurodollar account is simply a name for any account anywhere in the rest of the world outside the United States that holds dollars. There were more dollars held outside the United States than in, and with all the de-dollarization and the regionalization of commodities and countries dumping the US dollar and using other things, some of that money is starting to flow back in. I think the Fed knows all this. That's why they're tightening. They're tightening into the face of what scares them to death, which is all of those printed dollars coming back in the economy and causing a hyperinflationary event. So I do think that the Fed is doing what they can right now to give themselves space from an interest rate perspective, because they know there's an oncoming recession. Typically, it's 5 to 6 full percentage points of the federal funds rate that they'll want to cut in a recession to try to stave it off. I don't think that they're going to get to 5 to 6%. I think they'll get to 3 to 3.5. And it seems as though them setting the 3.4% rate and announcing that today is where they believe they can get to before they reverse course. So I think that they're going to continue to tighten the rest of the year, short of a complete market meltdown and some sort of liquidity event like we had in Lehman in 2008. I think they're going to continue to do it till they get to 3.4, and then they're probably going to sit there in a neutral position for a while and see how it goes. And if the economy at that 3.4% rate looks like it's breaking, then I think that they'll reverse course and they'll ease again. And I think that's what's going to lead up to the last big boom, or the crack up boom that we talk about on our channel all the time. And then where it goes from there, essentially, is probably a hyperinflationary episode. I think we have a little bit of time before that happens, but I think that's what the Fed sees. They're not going to tell us that, but I think that's clearly what they see.
It is interesting. It seems like this is what everyone's talking about, is that the Fed is trapped, because if they raise rates, then they crash the economy. And if they, reverse course, then we see that hyperinflationary episode, we see continued inflation. So you're saying, I guess, that they're going to continue to raise rates, but they're going to pull back, and we will see that other worst case scenario of just continued inflation going forward. So they won't be able to contain this.
Yeah, I think what you've seen in the corporate sector and in the retail sector, the consumer sector, is over indebted with debt. They have to pull back. You cannot run the economy on debt forever, because eventually you get to a point where you don't have enough dollars to pay off the debt. And that's where consumers are. Credit card usage is spiking. Consumer spending is down for the first time this year since the pandemic. Consumers are tapped out. Corporations don't have the earnings to continue this. Earnings were lower than expected. So where does the money come from to service that continued debt expansion? That's why all the tightening is going to occur. I think the Fed believes that they can tighten and have what we say a quote unquote soft landing, although bankers are already coming out and saying, no, we think it's going to be a hard landing. I think it was Wells Fargo the first to call for a hard landing this morning based upon what the Fed is doing. So I don't believe that everybody believes it's going to be a soft landing. I believe that a lot of the analysts, especially the bondholders and the banks who are dealing with all of this risk, are essentially saying, yeah, no, this is going to get worse before it gets better. And I think that's why we have such bearishness, on the mainstream media finally, after all of us in the precious metals community have been calling for it for several years.